Hello guys, welcome back to my channel. Today we are going to talk about a very powerful trading tool called the RSI indicator, which stands for Relative Strength Index, and specifically we will see how to use this indicator on pocket option. But before we start, make sure that if you are new to my channel, do subscribe and hit the bell icon so that you never miss any updates. So let's get started without wasting any time. First of all, open your pocket option account. If you don't have a pocket option account yet, you can sign up using the link in the description. If you sign up through our link, you will get a lot of rewards. You will get a welcome bonus of up to 100%. Plus, you will get free access to my Telegram channel where I provide free signals, and I will share the link below in the description. Additionally, you will get my free trading course, both in Hindi and English. So make sure you sign up through my link. This will give you a lot of benefits. The moment you sign up and make a deposit, even a small amount like $5 will work. Once you do that, basically you don't have to do anything else. I will provide the email below. You just have to write to that email saying that you have signed up using my link. Just include your customer ID in that email, and that's it. Our team will verify it and all the tools will be provided to you. Okay, so let's get started. First of all, what is the RSI indicator? The RSI indicator is a momentum-based oscillator that measures the speed and change of price. Okay, but first let me do one thing. Let me apply it to the chart so I can explain it to you even better. Okay, here you can also change its color if you want, which can help make the indicator stand out more clearly on your chart. For this example, I'll make it white so it's easy to see, and I'll set its thickness to 2x, which means the line will appear twice as thick as the default setting. Okay, so what exactly is the RSI indicator and why is it important for traders to understand? As I mentioned, the RSI indicator is a momentum-based oscillator that measures the speed and change of price. Its range is from 0 to 100. As you can see quite clearly, this is the distance or range from here to here as indicated. And it tells us whether an asset is at an overbought or oversold level, which I will explain to you in a little while. Generally, if the RSI indicator, let me draw it properly here, this is 100 and this is 0. Okay, the price oscillates around these levels. So whenever the RSI indicator line, you can see the RSI indicator line, whenever it stays near 30 or below 30, then this is considered the oversold level. We would say that in general, the price is at what we call the oversold level. Similarly, at any time that the RSI indicator is actually moving around 100 or goes above 70, this is what is commonly referred to as the overbought level typically. Now, what do oversold and overbought actually mean in practical terms? For example, let's consider gold as an illustration. You must have seen recently that gold went up to around $1,000. Sorry, it has gone up to around $1 lakh. If I'm not wrong, 1,000 or 1 lakh. Let me confirm that for you just for a second. Okay, $1,000, same thing, like $2,000 or $3,000 or $1,000, whatever it is. So let's assume $1,000. Gold had gone up to around $1,000. So all the trading analysts and business analysts who closely monitor the financial markets and provide expert opinions were saying that the price of gold had gone up too much in a relatively short period of time. According to their analysis, gold had become overbought, meaning that many investors had purchased it, driving the price to unusually high levels. In their view, it had reached a very high level, possibly higher than what was considered reasonable or sustainable at that time. Now, why did it become overbought? Why did its price increase? The reason is, as you might know from economics, whenever demand is much higher than supply, the price goes up, right? So overbought means that it has become overbought. Now from here, it will fall, its price will drop. Everyone believes that the price of gold has now increased too much. So from here, as soon as the stock market rises a little, gold will most probably, if not fall a lot, at least drop a bit. So that's about gold. This means an overbought price. Similarly, there's an oversold price like with Bitcoin. Let me erase everything first. Like Bitcoin, just 1 second. For instance, for example, Bitcoin is currently at 74,000 as of now. What's the current price of Bitcoin? Just a second. I haven't checked the latest update yet. 1 second, guys. Right, so Bitcoin is currently at $102,000. You might remember about 2 months ago, the price of Bitcoin had almost reached $72,000 to $74,000. So all the business analysts and trading analysts said the same thing, that Bitcoin's price had already dropped as much as it was going to, and most probably it wouldn't go any lower than that. This means that Bitcoin has already been sold off a lot and it won't be sold off any further. It will hold at this price and move upwards from here, right? So that's the concept behind it. I hope you understood this. Even if you didn't, it's not an issue. When we start trading, you'll understand. Okay? So what have we understood here? That whenever the RSI indicator line is below 30, meaning below the oversold level, we will assume that the price will rise from here, right? Similarly, whenever the RSI line is around 70 or close to 100, it means the price is at the overbought level. And most probably the price will fall from here. So that's the basic concept of it. Now, what we will do is the trading we are going to do will be on a very short time frame chart. Maybe we will do it on a 5-minute chart, right? We will do it on a 5-minute chart. So if the price RSI line is, let's say, around 30 or below 30, what should we assume? What will we conclude? That the price is currently low. So what should we do there? There we will take a sell trade. If one second. Okay. So whenever the price is at 30 or around 30, we will assume that the price has dropped a lot. So what will we do because of this? We will take a sell trade, whether it's for 1 minute or 5 minutes. I will tell you how. Similarly, if the price is around 70, this indicates that it is approaching what is known as the overbought zone. The overbought zone is a range where the price of an asset is considered relatively high compared to its recent performance, suggesting that it may have risen too quickly. So when the price is near 70, it means the price is currently high, right? This could be a signal that the asset might be overvalued or due for a correction soon. For example, as I told you about gold, whether it's $1,000, $3,000, or whatever the amount is. Or if I give you an even better example, let's take an easy one, like Bitcoin. Suppose right now Bitcoin is at $102,000, right? So that means Bitcoin is currently rising. The price is going up right now, right? What will we do in that situation? We will take a buy trade there, and if the RSI is also indicating that the price is high and at an overbought level, that means the price is currently elevated, and we will take a buy trade here. So this is its basic principle. This is the basic concept, and I hope you have at least understood the theory. If you found this theory helpful, now let's move forward with the trading session. So as you can see, this is the pocket option live chart, and here we have selected an asset EDCNY OTC, and I have drawn a support level here. As you can see, if you don't know how to draw support and resistance levels, I would highly recommend you join my trading course. It's absolutely free. I'll provide the link below. You don't need to sign up. Basically, you can just go ahead and start watching my trading course for free whenever you like. Okay, so as we can see here on the chart, an uptrend has just started to form. If you look closely, you'll notice the price is moving upward, right? But at this stage, we should wait for confirmation before making any decisions. Specifically, we want to see when the RSI indicator crosses above the 50 line. Once that happens, then we can confidently consider placing buy trades, as this is a stronger signal that the uptrend is likely to continue. Until then, let's look at other assets and check their charts. USD CAD, let's try and let's check. Is it worth taking a trade here or not? Here, friends, we can actually take a 1-minute trade, a sell trade specifically, because it's very close to the support level. So most probably in this situation, we'll see a bearish trend developing here. Yes, we've taken a 1-minute sell position here. Let's see how it goes. If we look at this level here, it's quite a strong level. If we use a horizontal line here as well, just like we did before, for example. Okay. If it breaks this level, if the price breaks this level, then most probably it will fall up to here. So here we can try a sell trade, and if it bounces back and goes up from here, then we can take a buy trade. Okay, so our very first trick actually worked, as you can see. It would be a little risky to take a trade here because it is very close to the support level, if you can see it, right? It's very close to the support level, and from here it could bounce back, so we need to wait a bit for confirmation here. If you look at the previous charts as well, if you look at its previous price activity, just a second. Here, there is a level. Okay. Okay, from here, most probably it will go up from here, yes. The last candle that formed is a confusion candle. You can also call it a doji candlestick. So at this stage here, we can try to take a 1 or 2 minute buy trade if you wish. Now, I'll try to take it a little lower. You should always remember one thing. Whenever you are taking a buy trade, try to place the buy trade as low as possible. So this will be my level. And yes, a level has formed here, and we have taken a 1 minute buy trade here. Let's see how it goes. For 2 minutes. I think a very good price will form here, and there will be a very good opportunity here with a lot of buyers coming in. This is because the current market conditions suggest that demand is increasing, and when more buyers enter the market, prices tend to rise or stabilize at favorable levels. So we will try to capitalize on this by positioning ourselves to take advantage of the potential upward movement in price. As a precaution, I see a support level here, so we should pay attention to it, as support levels often act as a safety net where the price may stop falling and start to bounce back. There is a support level here, but it's not that strong, which means that if the price drops below this level, it could continue to fall further. So this is one support level, and this is another support level, each providing a different degree of price stability. It's important to monitor both of these levels closely, as they can give us valuable information about possible price movements and help us make more informed trading decisions. So, okay, here we can take another buy trade for 1 minute. The reason for this is that the current market conditions look favorable for a quick upward move. By entering a buy trade now, we are aiming to take advantage of this short-term opportunity. Remember, this trade is only for 1 minute, so we need to watch the market closely and be ready to exit as soon as the time is up. When it comes to trading, one of the most important risk management strategies is to set your stop loss as close as possible to your entry point. This helps to minimize potential losses if the market moves against your position. Now, moving on to our current trade, we've just executed another buy trade with a duration of 1 minute. This particular trade was placed at a slightly higher price level than our previous entry, but after analyzing the market conditions and recent price action, I believe this is still a reasonable decision. It's important to remain flexible and adapt to the market as it evolves. Let's observe how this trade develops over the next minute. At this point, I notice that the current candle on the chart is nearing its expiration. To better monitor the upcoming price movements, I've adjusted the chart's time frame to 4 minutes. This allows us to gain a broader perspective on the market's direction and helps in making more informed decisions. If the next candle forms in an upward direction, indicating bullish momentum, my plan is to wait for the moment it briefly turns red, which could signal a minor pullback or retracement. As soon as I see this red color appear, I intend to place another buy trade with a 4 minute duration. This approach is based on the expectation that the overall trend will continue upward after the brief pullback. Now, let's take a closer look at the results so far. As you can see on the screen, 3 of the trades we have placed are currently active. Each trade was executed based on careful analysis of the price action, candlestick patterns, and overall market sentiment. By closely monitoring these factors and adjusting our strategy as needed, we aim to maximize our chances of success while keeping risk under control. Remember, trading requires patience, discipline, and a willingness to adapt to changing market conditions. Let's continue to watch how these trades unfold and be prepared to make adjustments if necessary. In this way, you can simply trade using a combination of support levels, trend lines, and RSI. This indicator is widely regarded as a very powerful tool among traders because it can provide valuable insights and help identify important market movements. However, when it comes to using the trend line in conjunction with this indicator, it is essential to understand how to apply it correctly. A trend line is a basic yet crucial element in technical analysis, as it helps traders recognize the overall direction of the market and spot potential turning points. Misinterpreting or incorrectly drawing a trend line can lead to If we look here on the chart, there's a significant level at this particular point, which is an area where the price has previously shown some reaction or reversal. Levels like these are important in trading because they often act as support or resistance, influencing how the price moves when it approaches them. So it will be very interesting to observe how the price behaves as it reaches this level, since traders often watch these areas closely for potential trading opportunities. There's another similar level here as well. Okay, so based on this analysis, we'll take a 4-minute buy trade here. The reason for this decision is that the last candle that formed was a Marubozu. A Marubozu is a type of candlestick that has a long body with little to no wicks, indicating strong momentum in one direction. In this case, it formed a pretty strong bullish Marubozu, which suggests that buyers are currently in control and that the upward movement may continue. Therefore, most probably this next candle will also remain bullish, following the momentum established by the previous one. That's why we've decided to take a 4-minute buy trade at this point, expecting the price to rise further. Let's see how this trade plays out and observe the market's reaction at these key levels. And then we will wind up this trading session. The reason a slightly bearish candle has started to form here is because because of this level, this price level, which is acting as a significant area of resistance in the market. When the price approaches this level, sellers tend to step in, causing downward pressure and leading to the formation of a bearish candle, even if only slightly bearish at this stage. At this particular point on the chart, based on my analysis and the patterns I have observed, I anticipate that the price is likely to fluctuate within a certain range. Specifically, I expect the price to move upward and downward in a somewhat oscillating manner, reflecting the typical market volatility seen in this region. Now, let's consider a scenario. If the price manages to break through this specific resistance level that I have marked, it is highly probable that it will continue to rise and reach the next significant level above. Conversely, if a bearish candle, meaning a candle that closes lower than it opens, indicating selling pressure, forms at this point, then the likelihood increases that the price will reverse direction and return to the previous support level. This kind of price action is quite common and is something you can observe and practice identifying on your own live trading charts. To help you get comfortable with these concepts, I recommend practicing on a demo account, which is a simulated trading environment where you can make trades without risking real money. In my trading course, I have provided a thorough explanation of how to use a demo account effectively, including detailed instructions on how to practice identifying support and resistance levels and how to execute trades based on these key areas. Practicing in this way allows you to build confidence and develop your skills in a risk-free setting before moving on to live trading with actual funds. In this particular example, we are taking a buy trade for a duration of 1 or 2 minutes. The reason for this decision is that the current price is very close to a well-established support level, which historically has acted as a floor, preventing the price from falling further. This proximity to support increases the probability that the price will bounce upward, making a short-term buy trade a logical choice. Therefore, we decided to enter a 2-minute buy trade at this point. If you closely observe the trade as it unfolds, you will notice that the price action remains very close to our entry point, reflecting the uncertainty and rapid fluctuations that are characteristic of short-term trading. Based on the analysis and the setup, this trade appeared to be a good opportunity, and the initial movement supported our decision. However, as sometimes happens in trading, the outcome did not go as expected. Despite being a well-reasoned trade, the result was not favorable, and the trade ended up being unsuccessful. Nevertheless, it is important to recognize that the trade was only slightly off the mark, missing the target by just 16 points. This small margin of error highlights the fine line between success and failure in trading and underscores the importance of precise analysis and timing. Even though the trade did not work out, it was a close call, and such experiences are valuable learning opportunities for refining your strategy and improving your future performance. But it was a good call. If you observed it properly, this is how you can trade with the RSI indicator, and I hope most of you found this video helpful. If you found this video helpful and informative, make sure to subscribe and hit the bell icon. I'll see you in my next video. In the next video, you will at least have some idea. If you have any doubts or need support, I will definitely help you. Just comment below and I will surely help you. See you in my next session.